Hello, everybody. It's Michael Martin. Thank you for being here today. So, one of the things that's kind of cool too about using a computer to do the simulation and you get the output, you can go through reams of data and investigate because sometimes the output on the computer program, it gives you your Sharpe ratio, your Sortino. It'll tell you, of course, your winning and losing percentages that add up, of course, to 100. It'll show you your average win, your average loss, your max win, your max loss. It'll show you, what your compounded annual growth rate is. It'll probably Monte Carlo, right? Because not everyone's starting on January 1st. Amazing, right? And then, of course, will give you, if I didn't already say, the expected value of the trade. And it will also give you like the magnitude of the drawdown and the duration, right? And all that stuff is kind of cool to see. But one thing that you can use to help yourself perhaps make even more money, even if you don't end up running and using the simulator to generate your orders day after day, is to go in and say, okay, well, here's my average loss. But really look at why did you lose what you lost, right? Can you improve your exits when you look at the chart of the actual trades that were put on? Because you might find that there were certain circumstances where you were using an ATR-based stop right away and it got hit. Perfect. Then there's other opportunities where you might have made some small bits of capital, then you were losing a little bit of capital. But you noticed when you looked at the chart that it's possible that there was support that could have been, say, closer to your getting out than if you had left the trade on and got stopped on an ATR basis. So in this case, you can look to maybe say, well, maybe I have a rule that I can override my ATR-based exit and trade structure when I see something like this, and then exit the trade, if it trades through support. Then you can go back and look, are there other similar charts where that had happened? And is that the best way to handle that scenario? Like, so for example, if support was broken, how many times out of, from a percentage standpoint, would have the ATR-based trailing stop gotten hit, right? And if there's a high incidence for that, then, you might want to consider looking at that to see if that could affect the expected value of the trade. Now, on the other hand, you can use this information to say, okay, instead of having a price target, what's the best way for me to handle my winners when I do win? Because for a lot of folks, offsetting winning trades, very difficult. Some of you might have price targets. When something makes a new high or, it goes up 3 ATR, you liquidate. For me, I always felt like, well, what happens if it goes up 4, 5, 6 ATRs from your entry, for example, if that's how you measure it, and I'm stopping myself at 3 just because I have that rule? It would seem for me that I'm leaving money on the table for the risk that I knew I was willing to take when I put the damn trade on. So then you look and you investigate. Like I said, you might have a trailing ATR based stop. You might have a structural type of a stop. For runaway markets, you might look for them to go parabolic. You could also look at reversals at the top to kind of give a little bit of a signal that it might be time to trim or offset the entire position. I know there are trend reversal patterns that you could look at as well that say, okay, well, I'm not just going to trail structure. I'm not going to trail with an ATR. I am going to look at a bona fide trend reversal pattern, and that's going to signify my exit. The other thing you could take into account is that when you think about trailing your winning trades with a protective stop, I'm a stickler for this. You might feel differently, but I don't call that a stop loss. To me, a stop loss is what you put in as a protective stop when you put the position on because you're losing money. Now, there will be those who say, well, Mike, it's never really your money until you take it. And I would say, you know what, you're right. I'm not going to split hairs. But for myself, on how I speak to myself in my own inner voice, I think of the money that is in my account from an unrealized gain standpoint is still part of the account because I'm calculating risk management techniques based on realized and unrealized gains. Some folks just look at realized gains as their account balance. They don't even count the unrealized gains. I would look at everything in a very fluid manner. And so my trailing stop, my protective stop, to not give back gains is the spot where I'm investing my gains into my stop. And the amount of risk that I have from the current market value to that stop is what I'm willing to risk in order to stay in the trade so that I could make more money. So where I'm going with this is you might have a model that says, okay, I'm right 40% of the time. And when you win 3 units. When you lose 60% of the time, you lose 1 unit. So you can do the math in your head. You have a positive expected value. But that's built on averages. And what happens when you look at your average gains? In the previous example, we looked at your average losses. What would you do if you looked at your average gains and you said, okay, let me segment my gains? How many times, if I had a price target, did it blow through that? And what would be the criteria that I could look for to give me a hint that there were greater gains ahead? Because don't forget, your odds and your probabilities change almost with every tick if you looked at it that way. But when you look with the computer, you can see what's the average campaign length, and you've gone through 3 ATRs, and it's only been 5 days, and you know the average campaign for your trading style is 9 days. Do you say, well, it's hit the magnitude, do I take it, or do you do it by day? You know, with commodities, a lot of commodities are seasonal. That's built on time, not price. Seasonality is the time of the year. So you might find that you had a price target, but from where you are in the chart and where your protective stop might be, you might find that you've got a 5-to-1 type of trade on your hands at a spot where you normally would offset the risk. So then you come to the conclusion that you've got to do a little bit more study, because you can see from that standpoint, even though you have unrealized gains that might be substantial, if the odds and the probabilities have changed after you've put the trade on, you have things to reconsider, right? Now, maybe you can take some of it off because you have an emotional need to do that. Or maybe you could leave it on. That's the type of criteria that you can get when you look at the numbers on the computer, because you can see the printout of it, right? You can go through that. And trying to do it by eye, I think, is a little trickier. I know some of you are super brainiacs, and you probably can do it. I cannot myself. I can see a lot of stuff, and I can calculate numbers in my head, but I probably am not as good, seeing patterns as I would be at looking at the data and doing the computation and then sitting back saying, even though I have an emotional pull to offset the trade here, the odds are suggesting that I have a 40% chance with a 5-to-1 reward to risk ratio from this point where I've already have unrealized gains. So that's just some food for thought on why you might consider looking at the data to accompany your chart reading. It all adds up, and it's very insightful stuff that you can learn how to trade around that and make better decisions. If you want something to listen to, you can get more of Michael Martin reading his book called The Inner Voice of Trading. I don't normally speak about myself in the third person, but I thought it would make sense to do so here. I'm giving away the audiobook version of The Inner Voice of Trading at Martin Chronicles, so go get yourself a copy. Thank you very much for being here, and I will see you next week.